catalyst for major change to how organisations operate in the future. But clearly this data also shows a wide range of other interventions being deployed, with an obvious continuous focus on health and safety issues, social distance requirements, and so on. And again, comparing the smallest organisations with larger organisations, broadly the trajectories are pretty similar, perhaps as we would expect, maybe because of extra resources at their disposal. Larger organisations seem to be adopting these practices even more than their smaller counterparts. Next slide. And then beyond people, when we look at the different operational and financial strategies being deployed, really this is a story of continued prioritised focus on taking cost out of the system, driving process efficiency, managing cash impacts, but you can also see some organisations thinking more particularly around the digital opportunities and scenario modelling as they look beyond the short term into the medium term and even longer term horizon. Next slide. As we look to recovery, what are our members' perspectives on the longer term impacts? Next slide. As I mentioned, we've seen significant experimentation with flexible and home working over the past few months. For some organisations, it's broadly proven to work depending on what sector you're in. And as you can see on this chart, and I think for many respondents, there's a clear sense that home working, or at least a more flexible approach to working, is going to be one of the lasting impacts for many organisations. And we know there are obvious upsides from environmental issues through to productivity and efficiency and so on. Clearly, there are some indicators again around the role of technology and digital investment as both a means to help organisations' immediate response to the crisis, but also how they can better plan out their recovery in the longer term. This includes digital investment in analytics capabilities and scenario modelling and so on, as well as the broader role of technology as a catalyst for transforming business models. Another key area to pull out here are the global supply chains. There is a lot of interest at the moment on the risk and dependency associated with global supply chains, and particularly geographical major nodes or countries which are instrumental to those supply chains. A third of respondents see potential supply chain restructuring as we look forward, and this is going to be really interesting to watch. Next slide. One of the additions to this latest report, which is also available on our hub that I mentioned earlier, is a recovery plan. Essentially, it's a roadmap of the things organisations should be thinking about as they plan their way to recovery, and it builds on some of the initial recommendations from the first report. It's simple, practical guidance centred around the critical areas you can see on the left-hand side here, such as workforce management, financial strategy, customer engagement, and data and digital transformation, and using an act, analyse and anticipate model. For leaders and board members, I draw your attention to the leadership, strategy and risk area and the importance of maintaining and delivering governance, taking a hard look at strategy and whether it's fit for purpose, and looking at how the organisation might need to transform to compete in the future. Next slide. I'm conscious this has been very much an overview of our latest data and findings. I hope it's been useful to you. And you can, of course, access the full results and analysis in our hub. Positively, it does demonstrate that by really understanding the challenges that our businesses face and taking a creative, forward-looking approach, there's a great deal we can do to safeguard the organisations we've built. Because of the severity of the global economic picture, not every business will survive, but those that act, analyse and anticipate will now stand the best chance of coming out of the other side ready to thrive. So thank you very much for listening.
Yeah, thank you so very much, Ms. Helen. Thank you for talking to us about as we look towards recovery, to recovery. You mentioned about certain long-term impacts which we are going to be seeing. Then you guided us. You also shared with us the study which has been done. You guided us on what should be our approach and how we should take it forward. What are the key areas where our focus should be? So thank you so very much. We wanted to take certain questions from you, but as the respected secretary, sir, is here, he's joined us just now. So, with your permission, I think we'll first have respected secretary's address, and post that we take, in fact, we'll because have both the views and the global perspective and the national perspective, and then we'll get back to the room on the field.
Very good.
Yeah. So, once again, a very hearty welcome as Dr. P. Somanathan, IAS, the Secretary, Department of Expenditure, Ministry of Finance, Government of India joins us. Thank you so very much, sir, for sparing in your valuable time. We really appreciate your joining us and your time as you've taken our time to make this schedule. So, as we were mentioning, we look forward to your views on more India's scenario from the national perspective and the finance scenario in the country, the post-19 era. So, if I can request you, sir, for your
A very good afternoon to all of you. Can one of you tell me whether you can hear me, because I've had lots of bad experiences with technology. So
very good afternoon.
You're audible. You're audible, sir.
Very good,
Audible,
very good.
Yeah.
Thank you very much. So a very good afternoon to all of you, and, particularly to my colleague Pradeep Yadav, whose organization I used to work in some years ago, and to Ms. Helen Brand, who has been CEO of an institution that I belong to and have belonged to for about 35 years now, which is the ACCA. It's a pleasure to be here, and I'm going to tell you a little bit about how the government in India is managing its finances and how we see our finances evolve in the COVID-19 aftermath. And maybe I can say a little bit, very little, what other parts of the economy are facing in the finance field. So I'll start by saying that we entered the COVID-19 era with an economy that was not really firing on all cylinders. It was growing slower than many people think India can grow. But the first 2 months of this calendar year were actually good months in terms of showing an uptick in the rate of growth, and we actually thought we were at the beginning of an improved rate of economic growth, and then we were presented with this irritating virus that arrived in March, after which everything changed, and we are no longer even looking at what the world was like in January and February. So when the virus arrived in India, which is late February, early March, when we had the first case, the first few weeks we expected some kind of slowdown, but to be very frank, we hadn't anticipated the magnitude of the impact that we have seen in the last few months. But by the third week of March, we knew that we were entering uncharted territory. And then on March the 22nd, India to one of the world's lockdowns, and one of the earliest lockdowns in terms of the sequence of the virus. We went into lockdown when we had approximately 100 cases in the country. So it was at that time, many people were posing the lives versus livelihoods trade-off. I think government in India took a clear choice in March to prioritize lives over livelihoods. And in fact, in the phrase that the Prime Minister used, "Jaan hai to jahan hai," that is, you only have, the world exists if life exists. And if there's no life, there is no world. So prioritized lives in the first few weeks. There was a nationwide complete lockdown. Epidemiological models tell us that we may have saved maybe 70,000 lives and about 1 to 2 million cases of COVID-19 through the lockdown. The first phase of the lockdown, the financial impacts on the government were that the government had to, since we knew it was a complete lockdown, shutting down a country of 1.3 billion for 3 weeks is not a trivial enterprise. So the government stepped in with a package of relief. This package was focused almost entirely on the poor and the vulnerable. So we came up with a package of providing free food to 800 million people in the public distribution system, free cooking gas to 80 million households, cash in their bank accounts to 200 million women in rural and urban areas. The government took on partial wage payments for people whose salaries were less than 50,000 rupees a month, and also arranged for releases from provident funds, welfare funds to be liberalized so that people could take back money that they saved without necessarily adhering to the usual all of those amounts. Sorry? Okay. So that was the first. You want me to stop? I'm sorry.
No, sir. So please continue, sir.
Yeah. Okay. So that was announced in the very first week of the lockdown, and the lockdown eventually got extended. It went on till in slightly relaxed form until the end of May, after which more relaxed lockdown, which we call the unlockdown. We then had the second government financial response, which came in the month of May. This was called the Self-Reliant India Package, or the Atmanirbhar Bharat Package. This financial package consisted of a collection of guarantees, deferments of tax and credit payments, and fiscal interventions. And the total size of the three of them together was 10% of India's GDP, with credit guarantees accounting for the lion's share of that. So the flagship element in that package was an unconditional extension of 20% extra credit to any business which was standard as of 29th February 2019. So that we chose that subset because if the business was creditworthy on the 29th of February, then we assumed that without any further assessment, they deserve to be supported with extra credit. So that was for approximately 1.5% of GDP, and about 1/3 of what was announced then has now been sanctioned by the banks. There were other guarantee and credit measures. There were some economic reforms because the government also saw this crisis as an opportunity to do things that in good times we may not have perhaps taken up the courage to do. So there have been a lot of restrictions on agricultural marketing in India, which have effectively prevented farmers from selling their produce where they wanted to sell it because there were regulated markets that had local monopolies over the marketing of agricultural produce. Obviously, there are groups that are in the present system. It had not been reformed, though lots of committees had advocated. So in this COVID-19 package, the government announced a decision to actually change that system so that farmers can now market anywhere in India, regulated, unregulated. They have the freedom to sell produce to the highest bidder anywhere in the country without having to go through local regulated markets. There was a new policy on the Indian public sector, which divides the public sector into two parts: strategic areas. In the strategic areas, the government announced that it would retain a maximum of 4 enterprises in each strategic sector, 1 to 4. And if there were more public sector enterprises in that area beyond 4, the rest would be either privatized or consolidated. And in the non-strategic sectors, the government has taken a decision that all the enterprises in the non-strategic sectors will be privatized. And it's the first time that the government of India has used the word privatization in an official policy, because we used to refer to it as disinvestment in the past. So it signals again a change in policy. There's a new sector which has been opened up to private enterprise, coal mining and mining in general. So these were some of the things that were done in the second part of the government's financial response. And then the third part of the financial response came last week, or rather a couple of days ago, when we announced an extension of the free food for 800 million people for a further 5 months, which again costs approximately 0% of our GDP. Having done all this, I'm often asked whether the government package is big enough or is sufficient to put the economy back on the rails. And the honest answer is it is not, because I don't think any government package is sufficient to put the economy back on the rails. The view that we have sitting here is that the key to the recovery of economic activity is not further government intervention. It is basically the abatement of the virus. It is basically when the consumer feels that they can actually go out, buy goods, services, go to shops, go to malls, travel, fly, etc. Because we have one piece of empirical evidence of the money that transferred to the 200 million poor women in India. It's spent in those bank accounts where the money was transferred is approximately 50% of what was transferred. And these are poor people, and the amounts that we transferred are not munificent. And in spite of that, only 50% has been spent. So basically what this indicates is that consumers are saving up because they see us as living through bad times. And there's only so much that can be done in terms of injecting liquidity into the economy and expecting it to revive. So we basically think that the turnaround will come maybe a couple of months from now when we have seen the worst of the epidemic and the numbers are starting to fall and people have the confidence that they can resume normal lives and normal business. So I must confess that our packages and financial measures that we have taken are basically painkillers and palliatives. The cure is really on the health side. So what we've done on the health side is we have spent a lot of money on the health sector. We've given the states a lot of money with which to do tests and create new ICU beds, buy ventilators. We've reconfigured 5,000 railway coaches into hospital beds. So a lot of money has gone into the health sector. And when the epidemic starts abating, I think that's when we will see the economy pick up. Coming more specifically to the issue of the government's own finances, we face probably one of the most difficult financial situations, not just in living memory, but probably in the memory of several generations, because we've had wars before. But in a war, there's some supply disruption, but there's a lot of additional. We face a situation now where we have a suppression of both supply and demand and a precipitous fall in the government's tax revenue because we have extended dates for payments of taxes, activity has gone down, imports are down, sales are down. So GST, customs is down, income tax is down, corporation tax is down, almost everything is down. Meanwhile, everyone wants a good package, and we've got 3 good packages, which are never good enough for people who want packages. But 3 sets of nicely wrapped packages have come at a time of sharply diminishing revenue. This means that the challenge that we have in the Ministry of Finance is extremely acute. We, at the same time, have to protect our long-term macroeconomic stability. So we are following a couple of strategies. One, we are looking very closely at our expenditure budget. We are enhancing budgets in areas like health, food supply, protection of the poor. We are reprioritizing in many other areas by switching budgets from ministries and activities that don't need them as much this year because it is a special year and a special circumstance. So to give you a simple but perhaps not very material example, I don't think the Ministry of Culture or the Ministry of Tourism is going to spend very much this year. If we let them, they would probably spend it, but we're not going to let them. So we have imposed a lot of cash controls. We have guidelines where we've classified activities into A, B, and C categories. So A category is primarily health and relief, where we have no restrictions on the spending of the budget. The B category is the middle category, where we have some restrictions. In the C category, we've imposed tight restrictions on paying anything other than salaries and interest payments. So with that, we have been able to manage our cash a little better. We're also increasing government borrowing. Obviously, there's going to be a substantial increase in government borrowing this year, which means a very high level of fiscal deficit. But I must tell you that we are somewhat optimistic that among the various shapes of recovery that we are talking about, the U, the V, the W, and the Z, and so on, we are expecting something like a V-shaped recovery. This year being at the bottom of the V and the next year being closer to the top of the V. So in that sense, we are not despondent. It's facing a very difficult year, but I think we will pull through. And I always think India is better at managing the downside than in achieving the upside. So I think we will probably do this job better than we will reaching 9% growth. I think we'll end this year reasonably well. We will probably not do as badly as the worst expectations expect from us. And in terms of the future, frankly, I'm not so sure that this marks a huge long-term discontinuity in the trends in the way finance is managed. It's too hard to say. I think many habits that have changed in the lockdown may actually when we completely normalize, if we completely normalize. And if the epidemic is forgotten a year from now, a lot of old practices are likely to resume. Working from home has picked up a lot in government. But one of the things that we are finding is working from home works very well for existing teams of cohesive people who are used to working with each other. But it's a difficult way in which to build new teams. So if you have people who've never worked with each other, starting to work with each other on WebEx, it just doesn't work very well. So it's okay for the short run, but I think in the long run, whether it's teaching or offices or managing teams, I think we will have to return to a normal where there's a lot of interpersonal interaction directly, and perhaps the trend in terms of electronic communication, etc. It will hasten the trend, but I'm not sure that it's going to be a big discontinuity. So those few words, let me thank you for giving me this opportunity. Thank you very much.
Thank you so very much, sir, for your analysis and also citing the trends which you see. And as you said, that probably this is going to be a little short-lived, which is and not actually becoming the next normal or the new normal. Also sharing with us the various initiatives and the policy decisions which the government has been taking time and again. But as you also mentioned that coming back to normal is also going to be more depending upon the consumer sentiments and how quickly we can actually build on the customer confidence of getting back, and that is when we are going to be seeing the economy again. But as far as the government is concerned, it has been taking these steps. It has been coming up with these packages, and it is, as we said, it's a V-shaped recovery which we are right now seeing. So thank you, sir, for your views. And if we have your permission, certain questions, if we can take from you, sir.
Yes, certainly. I have to leave at 5 minutes past 5, so that's another 15 minutes.
Okay, so with that, I will quickly hand over to Mr. Shailesh V. Haribhakti. He's an eminent chartered accountant, and as I mentioned, he's the chairman of Mumbai and the Western region for IoT India. He's currently is also the board chairman, the audit committee chair, the independent director of multiple boards in India, and also the chairman of Shailesh Haribhakti and Associates India. So I would like to request him to kindly chair the Q&A, and we'll take questions from Ms. Helen and from the secretaries. So over to Mr. Haribhakti.
Thank you very much, Vimi, and very warm welcome to you, Mr. Secretary, Mr. Somanathan, and Helen. Both of you have given us extraordinary food for thought. And my first question is a stringing of both the global and the domestic perspectives. And the question is that where we are looking at confident consumption being brought back, is there a correlation both abroad and in India to reducing the apparent burden of compliance? In India particularly, sir, we have 58,000 plus compliances. I just did a number count of it and updated it very recently. And 8,000 of them have potentially a criminal situation. So can that reversal or taking a saw to that kind of compliance burden, can that transform the confidence quotient that both of you spoke about? And therefore, a related question, can we think in terms of positively disrupting by shortening the legal redress cycle, by reducing the compliance burden dramatically, and by making sure that resources, both of equity and debt, are available to the absolutely starved sectors of our economy?
Should I go first?
Yes, please, Sam.
Please do, please. I feel like I might be treading on your territory here.
I see a lot of domestic content in the questions. So I should help Helen by going first. I think you're absolutely right on trying to minimize compliances. I think that is something that the government is conscious of. Perhaps we have more to do. We have already, and I think the finance said that more than once, that we are actively looking to decriminalize as many sections of corporate law and other economic laws as we can, so that fines replace potential jail. Not many people are actually taken to jail, but the threat of it and the slow progress of prosecution in India are punishments in themselves, and we recognize that. So we are certainly moving towards more and more offenses becoming compoundable in terms of fines, and perhaps eliminating some kinds of offenses completely. That also needs to be done. But right now is to decriminalize. That is a priority for the government, and the Ministry of Corporate Affairs is actively on that. You mentioned the point about the number of compliances. I have no doubt that you must have done your inventory correctly. But I would say that I've lived abroad for quite some time, and I don't know whether I can compare an exact number, but it depends on how you count. And if you count, I think many countries have lots of compliances. In fact, more sophisticated a country becomes, the more kinds of tends to have in terms of environment and social protection and employment protection. And it's not something to get rid of. India perhaps has got this peculiar thing where we have elite activism in many sectors that are much ahead of our economic levels of growth. So we have laws and things that are based on Western practice and an economy that is somewhere near, sub-Saharan Africa, and that kind of, that combination can be pretty difficult for industry. I understand that, but I think we shouldn't lose the protection of these progressive laws, because we do want workers to be protected, the environment to be protected. We don't want climate change to happen. So all of these things need to happen, but I agree with you that we need a better balance between number of compliances, the severity of the compliances, and of course the manner of enforcement of the compliances. You mentioned the legal process. I must say, with all due respect, that I have absolutely no control over the way courts in India behave. So the only thing that we can do from the executive side is to increase the number of opportunities to solve these problems without going to court. Once it gets into court, Indian courts are extremely independent, and they're very independent of the executive, certainly. And so there's very little that we can do in terms of speeding up things. And even if a law is passed which fixes a time limit, and about the bankruptcy code, the courts always say, well, that's the law, but that's only advice, and we're not bound. There's not much we can do on this.
Yeah, if I can just say from a global perspective, in the short term, certainly what we've been seeing is regulators can very much intervene to create conditions for survival. So holidays on certain regulations, tax compliance, or even as much as your motor vehicle taxation or whatever it might be, putting those holidays in place and being very clear that there isn't that pressure on people. But I have heard conversations about regulators as drivers of growth, or drivers of prosperity post crisis, and that's very much the thinking that you were talking about, where we can create the conditions for success and innovation, and releasing the regulatory burden where it's possible to do so, or maybe focusing on different, we all know, and I think we've seen again, the emphasis on environment and health. And it might be that the burdens go in a different direction to the ones that are in currently to drive a different kind of economic growth out of the crisis and helping that build back better concept that people are talking about. So regulators should put their super person capes on and see the opportunity to come to the aid of the business world, and I think therefore to the societies where those businesses operate.
Thank you. Thank you, Helen, and thank you, Mr. Somanathan. Very forthright answer. My second question is about the brilliant innovation that the government of India has done. What it has done is it has given relief, which is so required, in kind, by making food available from our towering stocks, which we had built up over all these years. And even this year, a bountiful harvest has been properly put away so that we can actually release this food. My question is, are there other such huge opportunities sitting somewhere? For example, converting railway unoccupied compartments to hospital beds was brilliant. How about converting the vehicles which are today not plying on our roads or sitting idle into ambulances? One of the critical things that we are seeing is that people need that to actually get to where they need to get when they need treatment. That's just one example. The other economic example could be, is there a potential for us to do a massive peopleization of the equity markets by making equity available to people who, just as Jan Dhan accounts have had an electrifying effect in India, is there a way to make a similar effect happen on the equity count? So these are the two questions that both of you can answer. Again, there's a global and a domestic perspective.
Well, certainly, if I just start on the repurposing or reimagining question, which I think we've seen, whether it's airline companies producing ventilators or, completely rethinking what they're using their capacity to do within the current circumstances, that's been hugely impressive. Going forward, I think there's a pressure both from, the public expectation will be very much that all parts, whether it's government or private business, will be looking more closely at that public good outcome. I think there'll be a clear expectation of that. And I think the business world probably should see this as an opportunity, but it does mean doing different things and using resources. It is all about resource, whether it's natural capital or people capital or the cars, etc. you're talking. It's about how do we use those resources to the greatest effect. And I think that there might be some challenges to the old capitalist view of what it is that businesses are there to produce, but that was coming anyway. I just think we've seen that accelerated by the current COVID crisis. So let's see this as an opportunity, but it does require imagination and it does require new skills.
Would you label it conscientious capitalism?
That's a good one.
Okay.
Yeah, yes, and I because the old system has not been shown to be totally broken. It certainly needs to evolve. Yeah.
Sir, can we get your response to, sir?
Changing the uses of existing assets and existing advantages is a good idea. We tried to do that, as you said, both with food and with railway coaches, but it is not always possible for the government to take the lead on highly decentralized private resources. So I think we should leave it to the Indian Jugaad to do all. They're pretty good at local innovation. And I think the government would be a very clumsy instrument instrument with which to do some of these things, especially the central government is so far removed from local communities. But I think the idea is good.
Thank you. Thank you very much, sir. A third question that comes up is, are these reliefs that the world is awash in sustainable? You know, we have an unbelievable situation where $5 trillion of actual fresh resources have been made available, either through printing or through making more credit available. And we have a stock today of $55 trillion of sovereign paper. Is there a market for it? Has the risk moved to the sovereign from equity markets to debt to sovereigns? And is this all sustainable? And if it is, what is the way that we will, when we see the V shape, how will we pull back? And how will it actually affect economies around the world?
Since I have a time constraint, let me give you
Yes.
my answer, and then I'll take leave of you if you don't mind.
Yes.
Yes, obviously we cannot sustain packages of this kind every year. But I think, I know that a lot of people wanted bigger packages from the government. We have always had to balance the long term and the short term. And what you're bringing up is the long term sustainability of our macro economies. So we have not taken our eyes off that set of instruments while we're doing the short term. And I think that is precisely why we're calibrating them carefully in terms of fiscal versus credit guarantees versus deferrals. It is not prudent to assume that you can simply pump prime your way through this crisis. In fact, it's our view that you can't do it, because even if you add more into this system, until the pandemic is behind us, you're not going to see proportionate results. So every additional installment of pump priming is going to give you lower returns than the previous one. But in terms of what's happening up to now, I think what the government of India has spent on the three packages, and we are quite conscious of the fact that they may not be the last. I think if we end this pandemic in, say, 3 to 6 months from now, we would not be on an unsustainable path. I mean, we are quite confident that we can see ourselves through this. Yes, we may have a debt to GDP ratio of the state plus center that exceeds 80%, but let us remember that, you know, there is a kind of double standard on credit ratings. India is at 80 plus. Oh, that's very high. But Japan's only at 250%.
Yeah.
And the US is only at 30. And, you know, so many EU countries, in spite of the fact that they have much lower growth rates than we do. And our long-term growth rates are likely to be, even if you have a pessimistic assumption, 5.5 to 6%. So with GDP growing at 5.5 to 6%, interest rates at 4%, and with our debt to GDP at 80%, sustainability is really not a problem so long as we don't go mad and splurge.
Absolutely.
And I can tell you, no intention of doing that. So I think we're on safe ground.
That is
Thank you very much.
So reassuring. Thank you very much, sir. This was fantastic. We
Thank
all
you.
would like to wish you all success in every strategy that you pursue. Thank you very much.
Thank you very much.
Helen?
Sure. I mean, in many economies, there's no question that public debt has vastly increased. That's, you know, that's unquestionable. But the short-term aim of preventing total economic collapse had to be had those actions had to be taken within that context, and I think most people recognise that. Many governments, you know, including the UK government, have been attempting to almost put the economy in a holding pattern until that revival that we just heard about. So I think that focus on returning to health and confidence is absolutely critical in ensuring that we don't see a longer term impact from this public debt to rising. There is a challenge now, you know, and that there is a challenge, and it be more of a challenge in some markets other than India than in India itself, which has that underlying growth capacity that other countries don't. But we think that, you know, it was action that needed to be taken, but we have to see the health situation brought under control.
Thank you. Over to you, Vimy. Back to you to carry on with the rest of the program. We've taken your 3 questions and we can move forward.
Yeah, thank you so very much, sir. And in fact, am I audible, sir? Audible to everyone?
Yes,
Yes,
yes.
Okay.
yes, madam.
So, yeah, thank you very much, sir, for this very interactive session. I think respected secretary, sir, message, and it was very reassuring that if the COVID is there going to be for another 3 to 6 months, then we are still on a very sustainable path. So I think that's a very optimistic message. And with that, we move on to the next address. And in fact, that's wherein we invite the view of the perspective of a banker. Uh, I would also like to mention here that we were supposed to be joined by Mr. Rajkiran Rai, the Managing Director and CEO of the Union Bank of India. But unfortunately, as he is not well, he has not been able to join us. But our heartfelt thanks that the Executive Director, Mr. Singh Hussain, is present with us. He's been kind enough to join us in this program. And as all of you are aware that Union Bank of India, the bank today serves almost 120 million customers. Further, under the guidance of Mr. Rajkiran Rai and Mr. Hussain, the Union Bank has been in fact aspiring to be one of the best banks in terms of customer excellence. So we invite the views of Mr. Hussain, and I would like to request him to share his insights and wisdom on shaping the future of banking with changing customer behavior as we prepare for the sustainable future. That over to Mr. Hussain.
Thank you, Vimy. Thank you, all the panelists and all the members who are there in the webinar. Good evening to all of you. There is no doubt that the upheaval caused by this pandemic is going to alter the customer behavior and the global financial system permanently. It is first time estimated that even the Indian economy may get contracted. The impact of banking is going to be a barometer for the state of economy. With every challenge, there lies an opportunity, both in short term and medium term. What and how large is going to be the long-term impact will depend critically on long issues of the pandemic. But then the consumer and consumption behavior is bound to change. A complete shutdown of businesses during the lockdown has led to a dramatic reduction of the cash flow and posed threat to the economies in entire world. To mitigate this risk, the government and regulators are attempting to fight the virus through fiscal and monetary expansion. Some of the important implications are the banks and the financial systems are awash with the liquidity and the lower interest rates. We all have surplus liquidity. We have people who are fighting for cash flows, and other way we have a system which is flush with the liquidity and surplus lower interest rates. This means that the visible and strong cash flows segments like agriculture, pharmaceuticals, healthcare shall prove more credit worthy, and which have been adversely affected during the time will fight for the cash and struggle for survival like aviation and hospitality. The situation can be addressed and is being addressed by the government and regulator both in terms of putting up the economy, putting up the money and putting up the guarantees. The second implication therefore would be that government will turn out to be a key player in the financial sector, both as a borrower as it finances its deficit and as a risk absorber by providing guarantees, backstops and more direct fiscal support for the borrower, which you would have seen that the government of India has proactively done up till now. Banks thus look for government support in judging whether borrower is a safe bet or not. To such an extent, the government fully understands that in some cases, and more particularly in the MSME sector, because of the losses, the capital of the MSME have been wiped off, and not only by way of the loans and guarantees, government is also planning to bring in equity fund for survival of the MSME. The new offering, there is likely to be a major shift in precautionary saving and risk aversion for the household. This increase could lead to an enhanced flow of saving to the bank, and on the other hand, households' propensity to borrow and spend may diminish a larger extent in the short term and to some extent in the medium term. With evolving customer behavior comes to the need of evolving business offering, and this trend shall significantly traction in the way of financial services. Our financial services will either be bundled or unbundled across different products and services. One of the many roles of the credit is to act as a temporary insurance to tide over shocks like this pandemic and subsequent lockdown and help to smooth consumption. Thus, a market for financial products that help hedge against the future crises are likely to develop. These products could build on need for precaution and risk aversion both among households and firms. We have seen in the past crisis that turmoil in economy and financial market reduces appetite for the complex instrument, and we presume that the post-COVID this scenario will also emerge. This will demand simply and affect margins of the banks. This will have to compensate with rising volumes. There are some things which we can expect. All of this is, however, dependent on technology strongly, and technology will become a game changer. Let us look at some of the technological overhaul that are likely to be in current scenario. One of the major issues which you would have seen that the organizing the webinars has become a most cost-effective and most imperative tools during this pandemic. All of us have effectively used our travel time and productively used our efficiency to these webinars. The digital offerings in some parts say that next time urban customer use a banking app and not the bank. In the month of June, there has been a record 40% increase in digital payment using the financial app. Even as the lockdown restrictions eased, the focus on social distancing will gain even more prominence and public spaces start to open. This health risk, coupled with the acceleration of digital products, mean for demand at home product and services expected to keep rising. Organizations need to move product-centric approach to customer-centric approach. Customer seeks experience and not the products. Financial brands provide excellent user experience. They are in greater place to build trust, establish fruitful long-term relationship with customers. A simple, clean, and intuitive user experience will allow bank and customer to overcome the challenges which we have mentioned above. With this, one stone, three birds. Personalization. We feel that nothing makes a customer spend like being a made to feel special one of a kind. Hyper personalization takes advantage of real time and data cutting edge technology like artificial intelligence to deliver more relevant product or services to the user. It is approach that takes personalization, as we know, it steps further. Such solutions integrate the customer data and provide hyper-personalized experiences and services to the customer. These experiences will enhance over a period of time, and the customer choices will surely move from the ready-made product to specialized product. We have seen that the real-time account opening through video KYC is a reality now. Indian banking have gone a long way in moving towards adopting the digital technology, and customer experiences, including the opening an account, is becoming more and more reality through an online platform. The regulator in this regards have also adopted the technological changes and provided the banks and financial institutions a flexibility in these regards. Customer can directly deal with the banks and can directly deal with the banking apps. Big data analytics will be in greater use for customer outreach. The biggest threat which we see for the legacy banks and financial institution is not the fintech or startup, but big tech platform who have already achieved significant scale in customer outreach and customer data. These platforms are providing services which are akin to the banking services. They have more customer data, more customer preferences, and more customer loyalty. These will really pose a challenge to the financial institutions and put them into a strenuous part for developing, redesigning their methodology and strategies to gain the customer confidence. Account aggregators. Banks will have to look beyond a simple binary of preferred and avoidable if they are to remain profitable. They will have to find way of gauging risk better and dive deep into risk profile of customers, both retail and the corporate, to enhance lending. This will call for a major upgrade in analytical tool and data built on complete risk profile of the customers, and this calls for a point for account aggregators. I'm sure you are aware of the account aggregator, but as our economy moves towards more and more digitalization, we will see the specific and general account aggregators playing a greater part in financial intermediation and helping the robust economy and banking system. The pandemic is unarguably a watershed event in the history of mankind that is bound to cause paradigm shift with far-reaching effect. Banking, being a pivotal industry, is likely to in the forefront of these changes, while we truly be able to gauge the impact of these adversities only once the crisis ends. In some cases, some experts say that this pandemic is one which none of us who are all hearing today have seen in our lifetime, whatever be our age. That means this is a dilemma for all of us and not a problem. In case of dilemma, we do not know what is the right course of action. We have to keep on looking the the, the events which are happening in and around us and keep on modifying our strategy to keep ourselves afloat. The first and foremost for all of us, whether in terms of the finance or in terms of the health, is to keep precautions and keep ourselves afloat. At present, the banks are functioning 80% economic activity as compared to 50% in April and May. That means we have come back from a setback which we have got in the month of March and April. While we wait for it around, we can focus right now on core strength, core business, consolidation, building trust for long-term relationship. We can also focus on smaller cities and regions where pandemic has not had an adverse impact, and essential sectors that are going to thrive, such as agriculture, pharmaceutical and healthcare, digital electronics and IT to begin with. As everybody says, the course of this type gives an opportunity for the strong organization to look inside and consolidate their strategies so that at the time of better economic environment, you can achieve a better success and better growth rate. Thank you.
Thank you so very much, sir, Mr. Hussain. And as you said, that COVID has actually brought us. You can hear me, sir?
Yeah.
So it has actually brought in what we call it as VUCA: volatility, uncertainty, complexity, and ambiguity. And so it is a dilemma which we are dealing with. So, and that's the reason we are seeing different models and strategies and experimentation. So on. So thank you so very much for sharing with us the trends which you see in banking and finance in this COVID era, and how it's going to be shaping in the future. And now I would like to invite our next speaker, and especially as we are talking about the customer sentiments, and we've seen a lot of change in the customer sentiments also in terms of having a concern on safety and hygiene. So herein we have a special address from a sector where both safety and hygiene have become all the more pronounced in this COVID era. So I would like to invite Mr. Pradeep Yadav, the IAS Managing Director of the Chennai Metro Rail Limited, which is the third largest metro rail system in the country after Delhi and Hyderabad. And today, Chennai Metro Rail aspires to provide a more comfortable, a more efficient, affordable, safe, and clean public transport service preferred by all in the same. So we'd like to invite Mr. Yadav.
Yeah, am I audible?
Anji, sir.
Yeah.
Yeah, Mr.
Yeah,
Yadav,
so-
you are audible, so we seek now your views and your insights.
Okay. So good evening to you all. First of all, I would like to thank IOD for giving me this opportunity to speak in this forum. We have heard senior panelists who have rich experience in corporate finance, banking, and the post-COVID-19 scenario, how the government, corporates, and the bankers are going to manage or shape the finances. Based on my limited experience, I'm going to talk about the urban transport sector, how the customer behavior is going to impact finances in this sector, and what should be the role of board of directors. Coming to the customer behavior, we all know by now that we have to live with Corona. There is no second way. And the customers are going to be very, very precautionary. They are not going to be pre-Corona. Stay at home, work from home, don't travel, save lives. These have become the norms of today's. And these 100 days of lockdown has actually made every one of us that if we go out, even for essential things, we have to be very, very careful. And over a period of time, now people have actually developed preference for the personalized mode of transportation, and they view public transport as as something which may or may not be safe. Now, because of this fear, we are going to have, even if we open up, our metros are closed now, even if we open up in near future, we are going to have this fear of contagion as a major threat to public transport. Safety of stations, safety inside rails, or even buses are going to be, this is going to be a major factor to get back the ridership to the normal state. Even if these customers go out and they prefer public transport as a mode of transportation, social distancing will further affect adversely the carrying capacity. You may not carry the same number of passengers in those buses or rails. That reduced capacity is going to adversely impact our finances. People may be scared of handling cash, tokens, or even smart cards. So we may have to do something on that count. Some of the institutions may resort to work from home. There are going to be less public interactions. I don't think people are going to prefer travel, leisure, or even tourism. So this is all going to impact the urban transport. Now, the impact on finances, as I said, once you have the reduction in ridership, it's going to impact our revenues. In fact, most of the metros, if you see today, they are all running. Some of them are on break even, only on the operational part. And most of the metros have taken loans, and the only break even we get is the operational break even. Our operating costs are going to remain the same, and the revenue will come down drastically. We may also have to spend a bit on safety measures. Unless we spend on safety measures, we are not going to get back even these passengers. So we may have to spend a bit more on safety measures. Working capital, most of the metros, working capital, which normally we had for 3 months, is going to dry up, because even during this 3 months period, we have paid wages, we have paid for sanitation and other expenditure. Our non-fare box revenue, which comes from advertisements and kiosks, that also will be affected in view of the poor ridership. There is a disruption in the construction activity also. The migrant laborers have actually gone back to their places, and it will be difficult to get back in the near future. So that is also going to affect our infrastructure part of it, which we have a major plan to expand. Now, the role of board of directors, what should be the role of board of directors, which we felt during the lockdown period. The first thing is that we have to launch a campaign on safety measures. We have to win over their confidence, or else we are going to lose revenue. We have to go for cashless and contactless transactions. And we have been working on mobile ticketing, contactless access and entry and exit. And all our stations are now actually retrofitted with such measures. We have also gone for foot-operated lifts, just to allay the fear of contacting corona. The corporate offices, actually, I must thank my predecessors. In fact, Dr. T.V. Swaminathan was also MD here. This organization has been following e-filing system. There is no paper work that is involved. All our clearances are done on e-filing. Accounts are computerized. So even during lockdown, we hardly had any case of delayed payment, and that actually helped us a lot. So my first suggestions to all the board of directors would be to go digital. Go digital, it will help you in future, not only against corona, but any disaster that comes in future. Go digital. In fact, even meetings are also virtual. We are not meeting, we are not reviewing in one room, and we are using technology. Smart governance. In fact, we have had a look on all those items of expenditure where we were actually spending, and we have done this 3 months time has given us a good time to look back and see where we are spending more. This has also taught that if we don't care for migrant laborers or other employees, I don't think we will survive in near future. And we have done all that was possible to take care of their emotional and physical health. The other requirement which the board of directors have to immediately look for is the contract management issues, which are going to trouble them in near future. Sooner we set right, the better it would be. And the third piece of advice is that explore new avenues of raising resources, where we have actually thought of business development, unlocking of land assets, and increasing non-fare revenue. So with these 2-3 suggestions, I would take leave. So my first piece of advice would be that go digital and innovate and diversify your services to hedge against any such contingencies in future. Thank you so much for giving me this opportunity.
Thank you, sir. Thank you for your analysis. And as you mentioned about the impact which you are seeing of COVID-19 on the metro rail, where, as you said, that the OPEX remains the same, but you see a dip in the revenues. And then you also mentioned about certain points where the rule basically approved pay charge and their approach should be in this period. So thank you for that. And we will now like to, if you have your permission, sir, some questions that we can take from you, sir. Questions. So I would like to request once again and invite Mr. Haribabu, sir. So if you can take the questions. I think Mr. Hussain has left. I believe Mr. Yadav continues with us.
Oh, so which means all my questions will be directed to Mr. Yadav. Wonderful. Sir, you made 3 very critical points. One is that all boards will have to focus on safety, simplicity, and creating trust, because only then will the customers come back. Is there a way? This is a question that somebody has raised, very interesting question. Can you make what might be called proof of concept, small cases? Like, let us take a small segment of the Chennai metro, or a small segment of the Delhi metro, or a small segment of the Mumbai metro. And can we demonstrate that you will have contactless, safe travel, and therefore get your faith back and use the whole network? This is the question that comes to our mind.
Yes, you're right. Actually, we have prepared a communication plan where we have actually shot some videos which will show that how a person can, without getting in contact with any staff, they can just buy a mobile ticket. It actually, our app provides for it. So once you make payment using net banking, wallet, or whatever mode of payment, once you make the payment for the ticket, you get a QR coded ticket on the mobile itself.
Okay.
And when you enter the station, you just have to scan that QR coded ticket, and the good gate will open. At the exit also, you just have to scan it. That's all. So at no point of time they have to contact anybody, or they don't have to take out cash or take back cash or tokens. We have shot some videos, but that metros are not running nowadays. The moment we get a nod, we are going to launch a massive campaign to win over their confidence. We know that people will be suspicious of our hygiene and safety measures, but we will definitely see that that we win their confidence and get them back to our rails.
Excellent. Do you sense that people in general will be happy to give up their old habits of using cash and will move to this digital form of buying tickets and interoperability between various public transport means and all the wonderful ideas that are actually in practice in places like Hong Kong can be brought to bear on our urban areas? And second related question, can you, in that case, contain costs and variabilize all your costs and make sure that the sustainability of the metros still remains strong, because as you rightly pointed out, there is debt to be repaid and the installments will become due.
You're right. You're right. In fact, meeting our obligations is a big challenge in future. There are talks that we should go for PPP mode or operational side, or unbundle things and go for operational components. But increasing ridership is the key in this whole sector. Unless we get the revenue, we are nowhere. Even in fact, until we get the ridership, there is even private people also will feel little uncomfortable in getting into this sector. So increasing ridership is our prime concern today. Raising revenue, yes, in future, once we establish a bit, we are going to try that even also.
Very much. I think we have run out of time. Vimi, back
Yes.
to you.
Yeah.
Yeah, we have actually run out of time, but I think we definitely had a very interesting and very informative and insightful session wherein we got able to get a domestic view, also a global perspective, a banker's perspective, looking into the financial aspects, and also from the metro rail, how the consumer behavior drastically changing. So, as we have run out of time, a big thank you to all our speakers for spending in their time. Big thank you to sir. Thank you so very much, sir, for chairing, especially the Q&A session and this interactive session. But before we close, I would like to invite now Mr. Ashok Kapoor, the Director General of the Institute of Directors India, to kindly propose a formal vote of thanks. If I can request Mr. Ashok Kapoor, sir.
This is Ashok Kapoor, DG IOD. This is Ashok Kapoor, DG IOD. First of all, on behalf of the Institute of Directors India, I have the privilege of welcoming some of the most distinguished speakers and experts that we could have at a short notice. And we are really grateful to especially Dr. T.V. Somanathan, who is the Expenditure Secretary, Government of India, to share his perspective on the ongoing crisis. Our grateful thanks also to Ms. Helen Grant, one of the leading financial experts in the world. She is the president of ACCA and the Institute of Directors. I'm especially grateful to her and ACCA that whenever we've had such occasions of brainstorming, she has been with us. And as usual, she's ready with the global perspective. Friends, on behalf of Jal Lalwalia, thank you all once again. Jal Lalwalia set the trend for the discussions today with his insightful analysis of the role of the boards in future, increasing their risk appetite for finance, and the new resilience with which they'll have to face the future, especially the twin crisis of the COVID-19 and economic crisis, the financial crisis. I would also like to first thank Ms. Helen Grant for our overall perspective on the global scenario, how the extensive and intensive global surveys by ACCA have given us a picture of the consumer response, the consumer demand, and I'm sure the boards and the directors in India who are closely following her very intelligent discourse will freshly evaluate what is going to be the consumer demand and consumer behavior in the forthcoming future. And we will also gain in India from the global perspective, especially the new ways to generate revenue growth. Our very grateful thanks to Dr. T.V. Swaminathan, who has given us the what Ms. Helen Brand gave the global perspective. He has given the all India perspective. That is how, though the economy has slowed down, but by interventionist, proactive intervention by the Ministry of Finance, the many of the problems that were staring us in the face are getting mitigated, and he gave the national perspective that lives matter more over livelihood. But at the same time, he's given the perspective how the focus has been on poor and vulnerable sections. The the expansion of the and his future prognosis of how the board will have to face, that is the activities on health, safety, environment, and evaluating afresh the supply and demand in their respective sector. As always, Shri Shailesh Hari Bhakti, as the announcer announced, that he adorns his multiple boards of some of the best performing companies in India. And Mr. Hari Bhakti has been a constant source of inspiration for IOD and its large family of members. He gave a new dimension to the webinar. He posed some very relevant questions. I would say that these are rhetorical questions, which I'm sure not only made various speakers rethink, but also the audience. That is how the brilliant innovation will impact the economy. He conceded some of the innovations are brilliant, and how such large induction of the freshly minted money will impact the Indian economy, and at the macro level and at the micro level, how the board should prepare. Mr. Hari Bhakti has always been some kind of a novel source of inspiration to set us thinking out of the box. The next eminent speaker, Mr. Gopal Gosai, gave the perspective of the banking sector. The banking sector in India, how it is going to be impacted, and how the banking sector is preparing to meet the future challenges. He outlined the role of digital technology, that how the digital technology and the data analytics will come to the use of boards for better performance and better ways of expanding the customer and the client base, whichever industry there is. And he gave us the very encouraging news that in spite of all the heavy odds, the banking sector in India, led by some of the well-performing banks, especially his in the public sector, has almost resumed its activity to 80% of the pre-COVID performance, which is really encouraging. And he also outlined some of the sectors in which the focus of the board should shift for a better study of the markets. He gave the example of electronics and IT, which fortunately have not been very badly affected by the COVID, and how the boards can take advantage of a minimal COVID-19 effect in these sectors. Last but not the least, Mr. Pradeep Yadav, we are really grateful to him, the very dynamic young, though he doesn't, he's quite young, I can assure you, though his picture on the does not do justice to him. So he's a very relatively younger civil servant of the Tamil Nadu cadre, and he gave he outlined the perspective of the boards in the urban transportation sector. We have noticed, we especially invited the Chennai Metro Corporation for the reason that we have noticed that a very major component of the current economic crisis has been the problem of intercity and intracity transportation. And he gave us some very encouraging news, his thoughts that how the innovative measures being brought about by his metro, like contactless and cashless duty and e-filing of clearances as the boards going digital are really going to prepare for the future. And his perspective on smart governance will be useful not only for the companies in the transportation sector but all across the industry. And he also gave us the guideline about how the boards must think out of the box on some of the issues that are non-traditional. Like, for instance, if there's a revenue shortfall, what can the boards do to increase the non-traditional shortfall in the transportation sector? Maybe if the fares are not fetching adequate revenue, how non-fare revenue can augment. It will be a good guideline for all the similarly situated boards in the transportation sector, not only in the intercity but intracity. So friends, with that, I once again thank all our distinguished panelists, and with the presence of Ms. Helen Band, we have really got a global perspective on the issue. Thank you very much once again.
Yeah, thank you, Mr. Kapoor, and thank you once again to all our speakers for sharing your expertise. With that, we come to the end of this webinar. Thank you all the entire team also for joining us for handling the technology part. With that, as we close, just requesting you all to stay safe and stay happy, stay responsible at your places. And this is, as we say, this is a short-lived period which we are in, and we are going to stay through very soon. With that, goodbye from all of us and the entire team of the Institute.
Thank you. Goodbye.
Thank you.